Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about trading options. Investors have different motives for integrating options in their portfolio. The main reason resides in the flexibility they provide. Incorporating options into a portfolio allows investors to trade a directional view with a limited and identifiable risk exposure. Investors also use options to take advantage of leverage. In addition, options can help to protect and preserve capital as well as generate cash flow and mitigate market volatility. While placing an order, an investor will have to determine if it qualifies as an opening or closing transaction. An opening transaction refers to any order that creates a new position or increases the size of an existing one. It includes the initial purchase or sale of a call or a put. A closing transaction, on the other hand, is one that eliminates or decreases the size of an existing position. It could involve buying back a call or a put that was initially sold or selling a call or a put that was already owned. A typical order to enter into a long call option position would be a buy to open order. Remember that any new order is considered an opening order. In this example, the call buyer wishes to purchase 10 50-strike call options with a June expiration and is willing to pay $2 per share for each contract. A typical opening transaction to sell a call that is not already owned is a sell to open order. In this example, the call option writer is selling 10 50-strike call options with a June expiration and wishes to collect $2 per share for each contract. As with the long call transactions, any new order, regardless of whether it is to buy or sell, is an opening order. With XYZ trading at $50 per share, the $50 strike call option buyer has the right to own the shares at $50, while the seller has an obligation to deliver them at the same price. The buyer pays a premium, while the seller collects a premium. The call option buyer will profit if the shares increase in value, while the seller profits if the shares remain at $50 or decrease in value. The call option buyer has a risk limited to the premium paid, while the seller has an undefined risk as the share value rises. The risk-reward profile of the long call option illustrates the unlimited profit potential of the position as the share value rises above the break-even point. Notice that the maximum risk exposure for the long call holder is capped at the amount paid for the option contract. If shares of XYZ remain at $50 or drop in value, the call option will expire worthless, and the call option buyer will experience a loss equivalent to the premium paid. The break-even point on expiration is determined by adding the premium paid to the strike price. In this scenario, the $2 premium is added to the $50 strike, resulting in a break-even point of $52 per share on expiration. The position is profitable as the shares trade beyond the break-even point. The risk-reward profile of the short call illustrates the profitability of the trade being limited to the premium collected. Undefined losses occur as the share value rises beyond the break-even point. If shares remain at or below the $50 strike price, the call option seller will collect the entire premium, which represents the maximum profit. The break-even point is determined by adding the premium collected to the strike price. In this example, the $2 premium is added to the $50 strike price. The break-even point on expiration is determined to be $52 per share. The call option seller has an undefined risk exposure as the share value trades above that break-even point. If the $50 strike option is in the money at expiration, call option buyers can exercise their right and take possession of the shares at the $50 strike price. If they do not wish to own the underlying shares, they can alternatively close the position by selling the call option prior to expiration. It is important to remember that a long call position can be closed at any time prior to expiration. By closing the position, the call option buyer will profit as the share value trades beyond the strike price plus the premium. The call option seller, on the other hand, may be assigned to fulfill the obligation to deliver the shares at the $50. If the call option seller does not own the obligated shares, they must be purchased at the higher market value and delivered to the call option buyer. If the call seller does not wish to buy the underlying shares, the call options can be bought back. However, a loss will be recognized as the call options will now be valued higher than the original sale price. The loss for the call option seller is calculated by subtracting the strike price from the current market value of the shares minus the premium collected. If the $50 strike option is out of the money on expiration, it will expire worthless. For the call option buyer, it means that the entire premium is lost. However, regardless of how low the share value drops, the maximum risk will remain the premium paid. Once the option expires, the call option holder has no further right to owning the shares at the strike price. With the options expiring worthless, the call option seller is entitled to keep the entire premium. The profit is limited to the premium collected, and there are no further obligations. To offset a long call position, the call option buyer must sell to close. In this example, the call option buyer wishes to sell to close 10 June expiration 50 strike calls. The price will be determined by the current market value and may be selected to either lock in profits or limit losses. It is important to remember that if the long call option is in the money and still held at expiration, it will be automatically exercised. To avoid this process, the call holder must sell to close the position prior to expiration. To offset a short call position, the call option seller must buy to close. In this example, the call option seller wishes to buy to close 10 June expiration 50 strike calls. Once again, the price will be determined by the market value and may be selected to either lock in profits or limit losses. It is important to remember that if the short call option is in the money and still held at expiration, the call option seller will be automatically assigned to deliver the shares at the sold strike price. To avoid this process, the call holder must buy to close the position prior to expiration. A typical put option buy order is constructed in the same manner as that of a call option. The only difference will be the contract description. The determination of the quantity, price, and duration of the order will be considered based on the trader's objectives. In this scenario, the put buyer is purchasing 10 $50 strike puts with a June expiration and is willing to pay $2 per share for each contract. Once again, any order to create a new position or add to an existing position is considered an opening transaction. In order to sell a put that is not currently held as a position would be entered using a sell to open order. In this scenario, the seller or writer would be considered to be short the put option. From the order entry, we see that the investor wishes to sell 10 $50 strike puts with a June expiration. The objective is to collect $2 per share in premium. The put option buyer holds the right to sell the shares at the $50 strike price, regardless of how low the share value drops. A premium is paid for this right, and the put option holder profits as the share value drops. The risk is limited to the premium paid. Conversely, the put option seller has created an obligation to buy the shares at $50 and collects a premium for taking on that obligation. The put option seller will profit if the shares rise in value or stay the same. The risk in the short put position is undefined as the share value drops. The risk-reward profile of the long put reflects the increasing profitability of the position as the share value drops below the break-even point. Note that as the share value rises, the long put risk is capped at the premium paid. If the shares remain at or above the $50 strike price until expiration, the options will expire worthless and the long put holder will lose the entire premium. As the share value decreases below the break-even point, the long put holder begins to profit. To determine the break-even point of the position on expiration, the premium is subtracted from the strike price. In this case, the $2 premium is subtracted from the $50 strike. In this example, the break-even point is $48 per share. On expiration, the put holder will profit if the shares trade anywhere below $48. It is important to note that the put holder can sell the options anytime prior to expiration to lock in a profit or limit losses. The risk-reward profile of the short put reflects the profit being limited to the premium collected, regardless of how high the stock goes, whereas there is an undefined risk to the put holder as the share value drops below the break-even point. At expiration, if the shares are trading at or above the strike price sold, the puts will expire worthless and the put option seller will keep the entire premium. However, as the share value drops beyond the $48 break-even point, the put seller will incur a loss. If the option is in the money at expiration, the put option buyer may exercise their right and either offset the shares that they are currently holding long in their account, or if the shares are not owned, a short position will be created. The long put holder may also close the position by simply selling the option. The profit is determined by subtracting the current share value from the strike price minus the premium paid. Conversely, the put option seller is assigned the obligation of purchasing the shares at the strike price sold. The put seller will assume a loss on the shares equal to the strike price minus the current market value of the shares. Part of that loss is offset by the premium collected. As an alternative, the put option seller may buy back the short put, realizing a loss equal to the strike price minus the current market value. The premium collected is then subtracted from the difference. If the options are out of the money at expiration, they will expire worthless. For the put option buyer, the loss corresponds and is limited to the premium paid, regardless of how high the stock is above the strike price. Once the option has expired, the right associated with the long put no longer exists. For the put seller, the options expiring results in the realization of full profits. However, regardless of where the shares are trading, profits are limited to the premium collected. Once the options expire, the put seller no longer has any obligation. The offsetting transaction to close a long put position from an account would be a sell to close order. This may take place at any time before market close on the expiration date. A put option holder may choose to offset the position to lock in profits, manage losses, or avoid automatic exercise. To offset the short option position, the put option writer would buy to close the appropriate number of contracts. A put seller can offset an option position at any time prior to expiration to lock in profit, cut losses, as well as to avoid having to buy the obligated shares. Before an option trade takes place, a proper analysis of the underlying security is critical to determine which option, a call or a put, is appropriate, as well as what strategy is best suited to meet the investment objectives. An investor should be comfortable and confident in how their trading software works, and if possible, spend time in a simulated trading environment to get used to placing orders and managing positions. It is also important to consider the margin requirements associated with some option strategies. As those requirements vary from one broker to another, it is critical to review them carefully before entering any position. And finally, the investor should always review opening and closing orders before submitting them to the market.